How I broke my mortgage in 5 to 7 years. The bank didn't see it coming. I used to think my friend was just making really good money, until one day he turned his first-year mortgage statement around and showed it to me. 93% went straight to interest. Only 7% went to the actual loan balance. He pointed at the numbers and said, "This is where the bank makes all their money. The first 5 to 7 years. If you break this period, the whole mortgage falls apart." That was the first time I saw an annuity not as a boring table in the app, but as a real trap where you barely move forward. Today I'm going to show you the exact same strategy he used. No secret hacks, just the math that banks really hate when you understand it. Hey, what's up guys? My name is Cashflow. If you have a mortgage right now or you're thinking about getting one, this video might save you hundreds of thousands of dollars and decades of your life. Smash that like button and subscribe right now because this video might disappear tomorrow. Part 1. The first statement that changed everything. The scariest thing about a mortgage isn't the interest rate or even the total amount. It's the illusion that you're actually paying down the debt. Look at this. First year, monthly payment $100 and $400. Out of that, $1,300 went to interest. Only $100 touched the principal. He said, for the first 5 to 7 years, you're barely moving the loan. The bank is basically charging you rent for your own house. And then he showed me the amortization schedule, where the graph looks like a slow climb. That's exactly where the bank already made 70 to 80% of their total profit. That's when I realized, if you want to win, you have to attack the principal, and you have to hit it often. Part 2. 2 smaller hits instead of one big one. Most people make one big extra payment once a year. He did 2 smaller ones, sometimes 3. Why? Because every time you reduce the principal, the bank has to recalculate the interest on the new lower balance. 1 payment equals 1 recalculation. 2 payments equal 2 recalculations. He showed me the math. The difference between one $3,500 extra payment and 2 payments of $1,750 each was almost $2,200 in total savings over the life of the loan. Not because the total amount was bigger, but because the interest got squeezed twice. This isn't magic, it's pure annuity mechanics that banks never explain to you. Part 3. Paying when it hurts the bank. The most brutal trick came next. He didn't pay on the convenient date. He made extra payments in between the regular due dates, specifically 10 to 12 days after the main payment when the interest for the current month hadn't been fully locked in yet. Simple example, just $100 extra, paid 11 days after the regular payment, cut more than $500 off the entire loan term. Why? Because that $100 went straight to principal instead of being eaten up by already accrued interest. The bank counts on you paying like everyone else on the due date. He paid when it hurt the bank the most. Part 4. Never let them lower your payment. Every couple of years, the bank would offer, "Let's lower your monthly payment so it's easier for you." He always said no. He put it like this: a mortgage is a relaxation game. The moment it starts feeling easier to breathe, you start paying for way longer. He kept the same monthly payment, and every month a bigger and bigger portion of that payment went to the principal instead of interest. The loan term started collapsing on its own. Every year, he was shaving off 8 to 12 months. Part 5. His bulletproof formula. His formula looked almost boring, but it worked like steel. 1. Frequent micro payments, 2 to 3 times instead of 1. 2. Pay in the gaps between due dates. Hit the interest while it's still open. 3. Never reduce the monthly payment. And 4. Most importantly, always calculate. Always. He said, the bank isn't hiding anything. They're just betting that you won't bother to count. A mortgage isn't won by the person who earns the most. It's won by the person who reduces the interest the most times. If you're paying a mortgage right now, do these 3 things today. 1. Pull up your first year statement. 2. See how much is actually going to interest. 3. Start using at least one of these 5 tactics. I've already started applying them myself. I'll show you the results in a couple of months in the next video. And now, the most important part. If this video opened your eyes or actually helped you, hit the like button, subscribe, and turn on notifications. Tomorrow, this video might be gone, and these insights will be lost. Thanks for watching till the end. We'll see you in the next one. Peace.